The stock market's new normal is the future of never-ending chaos. Wall Street's insistence on clinging to the past is about to screw over a lot of investors. Wall Street desperately wants the stock market to go back to the good old days. Like during the pandemic when interest rates were at zero, the government was mailing checks to everywhere, and it seemed everyone had so much real money they were using it to buy fake money. In that environment, any idiot or anyone on Wall Street could buy almost any asset, sit back and watch its value increase. Stock didn't just go up, they soared. Now, Wall Street has even concocted a fairly convincing story for how the market will get back to this state. The Federal Reserve's rapid interest rate hikes will cause the financial system to seize up. They will blow holes in the real estate sector, and layoffs, which have already hit industries like tech and media pretty hard, will spread across the economy. This will in turn usher in a recession that forces the Fed to reverse course and cut rates to juice the economy again. After a few months of turmoil, the market will settle back into the low interest rate environment that defined the pre-pandemic decade, and stock will be on cruise control once again, a return to normalcy. There's one problem with the Wall Street story. It's completely backward. I think of the great mispricing of the market right now is the idea that we are going to cut rates by the end of the year. Justin Simon, the managing director of the hedge fund Jasper Capital, told me, for that to happen, we'd have to have a crisis, and I don't see that. Consider instead what the world would look like if higher rates don't break the U.S. economy but just bend it into a different shape. In this scenario, growth persists, albeit at a slower rate. Consumers keep pulling their weight and we don't have a recession. There is a pain in some pocket of the economy and inflation remains a concern, but there is no immediate crisis that forces the Fed to reverse course. In this scenario, the stock market gets choppy. Some stocks will win and others will lose. Charts will look ugly. The market may go sideways. Wall Street stocks peakers may have to sweat a bit to make their clients happy. There's going to be a slowdown here and an acceleration there, one legendary fund manager told me, but it kind of feels like the economy is just grinding on. It may be less convenient for Wall Street, but the reality is that our new inflation era is by no means over, and that's not a terrible thing. Cutting interest rate to zero was a move made to review an economy on the brink of death. It was a pull in case of emergency valve that we pulled for so long, and now it feels normal to Wall Street. But it's not okay. Keeping rates low in a healthy economy is like pushing an able-bodied 9-year-old kid around in a stroller. Sure, you can do it, but at a certain point, you have to accept the fact that the assistance is starting to stunt their development. Or as one family office head put it to me, if the Fed has to resort to rate cuts to stabilize the economy, that means we'll all become a bunch of pantsers who can handle real estate or stock declines and think that asset prices only go up and to the right. Now, as unsettling as the bank failures and stock plunges we've seen over the past years can be, they are a part of capitalism, not an aberration. When circumstances shift as violently as our economic regime just did, heads will roll. And while that may take the lives of the Wall Street investors a bit tougher, that doesn't necessarily portend collapses for the rest of the economy. It's just the start of something new. Now, going back would be a bad sign, of course. The pandemic made the economy so weird, it's hard to tell exactly what's coming next, but that hasn't stopped Wall Street from trying. Every quarter, analysts warn that a recession is just around the corner. Just wait 6 months, it'll hit. Some even argue that a recession is here and we just haven't seen it. Like a family goes over socks lost in laundry. Now, despite this constant caterwauling from Wall Street, Americans are working, spending, and helping the economy define doom and gloom forecasts. Earlier this month, the San Francisco Fed calculated that consumers still have $500 million in savings left over from pandemic stimulus and spending changes. In another recent Federal Reserve survey of more than 11,000 Americans, most people were downbeat on the overall economy, but when they were asked about their own personal financial situations, they seemed less worried. 73% of the people surveyed told the Fed they were doing okay or living comfortably financially, and 63% said they could cover a $400 emergency if they needed to, near a record high for the 10-year-old survey. Now, helping to support Americans' solid financial situation is a strong job market. The latest monthly payroll report showed that the U.S. added 253,000 jobs in April, and the unemployment rate tied the record for the lowest since 1967. The number of people claiming unemployment insurance also remains near 40-year low, and there are still plenty of jobs that remain unfilled. In April, when the most recent data released, job openings rose to their highest level since January. A strong labor market and healthy household balance sheets means that consumers haven't stopped spending. Given the fact that consumer spending makes up nearly 2/3 of the US economy, it's hard to imagine some sudden economic collapse while Americans are still willing to pull out the credit card. Retail sales increased a respectable 0.4%. Auto sales, which has been sluggish during the pandemic due to supply constraints, are starting to pick up. Most Americans have adjusted their habits, buying cheaper products or delaying big purchases. The economy also is changing, and consumers are changing with it. That's what executives at stores like Walmart and TJ Maxx are seeing in their sales. There are even signs that some consumers haven't changed one bit. Over at Bloomberg, Joe Weisenthal has been highlighting executives who are telling investors that if a recession is coming, no one has informed their customers yet. Now, we currently see no sign of change in customer behavior, so indications that customers are shopping less frequently, buying pure items, or trading down. Urban Outfitters CEO Richard Hannes said on a recent call with investors. Now, back in 2009, policymakers set interest rate at zero, hoping that eventually the U.S. economy would be growing strong enough to withstand higher rates. Well, that dream has come true. The U.S. consumer is pushing through higher rates and high inflation. It's all happening in circumstances at speed no one expected at that time. That just might not be convenient for stocks. Now, a choppy new world. Since the start of 2023, the stock market has been high on AI-driven hype and hopium, convinced that everything will go back to the way it used to be. The old market winners who dominated the low interest rate world are reversing their 2022 losses. The tech-heavy Nasdaq is out 30%, and the S&P 500 has returned about 8%. When trades are made and portfolios are structured for a specific environment, Wall Street has a way of convincing itself that past performance is in fact an indicator for the future or future returns, but the coast is not clear. A resilient U.S. economy seems like it would be a good thing for the stock market, but it also means that Wall Street consensus is treating higher rate as a temporary bout of strange weather when they are actually a change in climate. Inflation could stick around as strong consumer spending allows companies to keep prices high without losing businesses. A world where the Federal Reserve has to keep one eye on inflation means keeping rate higher for longer. That's a world where savers can have a leg up on spenders and where it's more expensive to borrow money. And the logic of investing changes. If investors can make a guaranteed 5% return investing in 10-year treasury bonds, they'll be less likely to put their money in a startup or venture fund that may not see return for a decade. Highly leveraged institutions will run the risk of blowing up, so corporations will be more careful with their spending as well. Sectors with businesses model that rely on debt, think commercial real estate and private equity, will experience implosion as time goes on. Todd and Slug's chief economist at Polo Global Management referred to this future as a non-recession recession. The 15-year of money printing created a significant bubble in asset prices, he said in an email to clients earlier this month. As a result, the big correction during this recession would not be in the economy but in the asset prices. The Fed continues to deflate the buy everything bubble created due to global easy money. This new normal would defy Wall Street's expectation and bring about a period that frankly is not as fun for stock as the last one. The pandemic era produced back-to-back years of record corporate earnings, but now wage inflation, the more price-sensitive consumer, and higher borrowing costs are set to eat into corporate margins. It's time for investment professionals to pick winners and losers in the market. It's time for them to dig into a company's balance sheet and make sure they have good management. All of this may sound basic, but in a bull market, it can and did easily fly out the window. Yes, the Nasdaq is up 26%, but I don't think we buy into rallies anymore, Simon said. Now we're going into something a little more choppy or flattish. This should make for an interesting summer. Now, as with all things in investing, the key to this will be timing the transition between Wall Street's denial of this new rate regime and its acceptance of it. The problem the economy is facing today are not the same problem it faced in recent past. Inflation has not been defeated, and no one knows how long it would take to tame. Now, reshaped but not wrecked by these new conditions, the American economy pushes forward. There is no going back.